Let me jump over here and start the Zoom meeting. The Zoom meeting is not yet started, so let's see if I can figure out how to start the Zoom meeting. Here we go, starting the Zoom meeting, looking for participants. Welcome, if you're watching on Facebook or the YouTube. This is Personal Finance at the Bauer College of Business at the University of Houston. And we're live now, and I'm now letting people into the Zoom meeting. And the only person in the Zoom meeting at the moment is moi. So this is the 11:30 class, the class that really wanted to meet in person this semester. And I'm looking out into a very full ocean of faces, smiley faces. Actually not. I don't know where you guys are, but I miss you. What do you think? What was your name? Ruth. Ruth, you've been here every week, right? You like being in class? How do you like being in class alone? Feels weird, huh? I'll try not to harass you. I'll pretend I'm just doing online. Even though we've got Ashley. It is Ashley. Every time I think Ashley, I think of you. I have like 3 Ashleys this semester. And I always wonder if I'm getting confused, because I do get confused. Okay, it's not quite yet time to start. Well, it is time to start, but you know what we do every week? We wait, because on Zoom, usually people don't show up on time. It's like they have to wait until the next commercial or the next Facebook break. So we will wait until 11:35, and I will continue to admit the folks who are coming on board on Zoom. Can you guys hear me on Zoom? Can somebody give me a sound check, please? Awesome. Thank you very much. Hope you guys had a great spring break. My understanding is that spring break ended yesterday, right? So today's the first real day back to class, which explains such light attendance, I think. Maybe. What do you think, Ruth? Is this your first class today? Was it full? No? Okay, good. So I don't have to feel like it's just me. 'Cause I do feel like it's just me. Like, so many of those of you who are normally here aren't here today. And, I'm here because of you. So anyway, maybe we'll see you next week. Maybe. Okay, one announcement is about the homework assignment that was actually listed in Blackboard as due today. The insurance assignment, where you do your homework, you do your auto insurance quote. That assignment is changed in Blackboard to be due next week, because that's what the syllabus said. Every semester, every spring semester, it seems like I'm about 500. I bat about 500. I sometimes make a mistake, and we should not have had 2 weeks with no assignments. So I'm going to be making up for that. We're not really behind, but anyway, moving forward, it's going to go kind of fast. But this week you're not going to get a new assignment. Your assignment will be due Tuesday. Yes. Yes, if you turned it in early, you're definitely going to get extra points. I may give you an extra more than normal. Yes. Yep. Yeah, if you turn it in fact, if you turn it in by probably Friday, just like normal, Friday at 3 p.m., I'll still give you extra points because I'm generous. If you turned it in last week because you were paying attention to Blackboard, you'll probably get a few extra points. So I'm going to wait until next week to make the next assignment, because Next week, I will be teaching you the things that I think you're going to want to know before you do not next week's assignment, but the week after. So next week's assignment, again, to be clear, is the insurance assignment that has been updated in Blackboard, and it shows a due date of next Tuesday at 10 a.m. So next week, we're going to jump into investing, and that's where we're going to stay for a little while. And next week, I will assign that assignment, and we'll talk about that next week. We're going to talk a little bit about it this week, too. So I want to cover 3 things today. And I'll just tell you, because we have very light attendance, if you have questions, please get those questions into the chat so that I can answer them. Because if we don't have a lot of questions, I'm going to lose my voice and pretty much let you watch the video from the first one. I covered a lot of stuff. If you want to see everything I covered in the first class, it is going to be in your playlist. I'm not going to post this one in the playlist, but I am going to hit the highlights. I'm going to cover everything I covered in the earlier class, but there were a lot of questions, good questions in the earlier class. So if you don't have a lot of questions, I'm not going to prolong today's lesson. Is that fair? Okay, cool. So 3 things I want to cover. First is we're in a midpoint in the semester. We're moving into investment management, investment strategies, which has been the most popular topic in this course since it began. So we're going to spend several weeks on investing, investment management, investment strategies. Specifically, I want to teach you 4 investment strategies that are designed to help you maximize your returns and minimize your risk. So I'm going to be teaching those 4 investment strategies next week. Today I'm going to talk about something that I'm very fond of, and I call it the perfect investment. And that's going to set us up for next week's lesson. But before I talk about the perfect investment, I want to spend a little time reviewing insurance and covering a couple of questions that have come up over this week and come up every semester. So we'll spend a little bit of time reviewing insurance before we jump into investing. But first, I want to tell you guys about something that's available to you that I want to encourage you to participate in. And that is at missionalmoney.com. So I may have mentioned it before that I do a podcast. It's kind of new. The podcast is called Missional Money. You can find it anywhere podcasts are played. But it all comes from the website missionalmoney.com. So that's what's up on the screen now. You'll notice when you go to missionalmoney.com, there are 3 buttons at the top of the page: subscribe, enroll, and let's make a plan. So I want to talk you through how this works and why you might want to take advantage of it. But I want to make sure you know that this is for students. It's free. It's completely free. It's for students who have taken this course. It's like the next level of training for students who want to learn more about financial planning and investment management. If you're taking this course because you just wanted to get an easy A, way to go. I hope you get the easy A, but this is not for you if you just wanted to take a course and get it knocked out. But if you're interested in learning and growing in personal finance, then I really want to encourage you to check out missionalmoney.com. The first thing you'll want to do is click on the subscribe button, and that will take you to the podcast page where you'll see wherever you like to listen to podcasts, it's available. I would encourage you to leave a review in iTunes. If you want to be part of this, leave a review in iTunes, and in that review you can tell me what you're most interested in learning, because the podcast is really just part of, whoa, that's weird. The podcast is really part of, I think I know what I can do to fix that. There we go. The podcast is really part of the overall program at Missional Money. So we've got the podcast, and then we've got a course, just like you're in Money Study Group right now. That's where you get the training material for this course. This is Missional Money is the course that's part of, or Make Your Money Count is the course that's part of Missional Money. So when you click on Missional Money, you've got subscribe, that's the podcast. You've got enroll, that's the actual course that you'll be invited to participate in. And then let's make a plan, and I think you'll probably notice that the Let's Make a Plan, it's the same platform that you're using in Money Study Group. So I've had several people ask if, hold on. I've had several people ask if you will be able to keep your financial portal and your financial plan in place after the semester, and the answer is yes, if you kind of enroll in the next level. If you don't, I'll just delete your plan. It's no big deal. You can come back anytime you want to missionalmoney.com. I'm going to try and get back to where I was. You can come to missionalmoney.com anytime you want and just get, kind of pick up where you're leaving off after this semester. So that's what I wanted to announce for next steps. It's called missionalmoney.com. And I want to tell you where that name came from. You guys, you remember the debt snowball that we talked about with Dave Ramsey? Did you remember that? Yeah, it's a strategy, and you did it in your financial plan where you did the credit crush assignment. But Dave Ramsey is he's famous for helping people get out of credit card debt. And so he teaches this thing he calls the debt snowball. I'm sure someone else invented it, but Dave markets it really well. And when he teaches it, he's been part of this course for many, many years. And so when I first heard Dave teach about the debt snowball, he used a term that really made sense to me. He talked about gazelle intensity. Do you guys know what a gazelle is? Yeah, it's a four-legged mammal that is very fast, and he used the idea of gazelle intensity for people who wanted to get out of debt, who wanted to have a plan to get out of debt. So he teaches the debt snowball around this kind of underlying idea of the gazelle intensity. And it made sense to me because I know that no matter what goal you choose for yourself, if you have a certain level of commitment and clear purpose, you're going to be way more successful. So the third law of personal finance is the law of purpose and commitment. Well, missional money is just part of that idea. And it really came from Dave Ramsey's gazelle intensity. I think I told you the story about me visiting Dave Ramsey's offices in Tennessee and how people come to the office and they sign. When they get debt-free, they sign, they do a big Yahoo on the radio show, and it's really cool. It really is cool. And so Dave did that one day just randomly. He said, I want you just to write your name and put the date on the wall. And then they did it with the next person and the next until all the walls in that building were full of people testifying to the fact that they got out of debt. They're totally debt-free. And then after that room got full, they went to the next room upstairs and the next one. And if you go to see Dave Ramsey's facility and you go to all the buildings, it's pretty cool because it's all over there. It's every building, every wall, right? That's where this idea came from. Gazelle intensity. Missional money is about financial planning and investment strategies, but it's like the next level. And I'm teaching this for my clients and my clients' families and their friends, people who want to learn more about how they can put their money to work in a wise way by having a financial plan and using good investment strategies to build wealth. It's about, people who want to save more money, pay lower taxes, and build a better retirement. Missional Money is just a place to do that. So it's a podcast, it's an online course, and it's the same planning portal that you've been using in this course. It's all sponsored by my company, Bayrock. Everything that you guys get in this course, you will get at Missional Money. And it's all premium stuff. I don't know if you know that, but it's not free. It's very expensive. It's for my clients at Bayrock. But as I teach this course, it made sense to me, especially when we went online, it made sense to me that I integrate these tools that we have, that I have available to me because of my company, to make them available to you. So I know many of you are not really here because, I mean, I hate to say that. I assume that some of you really just want to finish the course, get your A, and move on. And that's awesome. Great. I hope I can help you do that. But at some point, you're going to want to come back and learn because you need to know how do you do this. And that's why Missional Money exists. It's for people who really want to stay engaged in personal finance and growing by building a plan and learning bit by bit about investment strategies. Okay, makes sense? So here's what you can do if you want to be a part of this. Since we don't have an assignment this week, I'm asking for a favor. You're under no obligation to do this. I don't think I can give you extra points, but you'll make me smile. If you'll go to missionalmoney.com, click on subscribe, and leave a 5-star review for the podcast in iTunes. The way iTunes works is if we don't get reviews, I don't even know if they have to be 5-star reviews, but we need reviews for the show to even show up. And so it's a new show, new podcast. You'll be doing me a big favor. But when you do that, don't just leave a review. Tell me what it is you would like to learn or what you would like to focus on if you participate in this next level at Missional Money. Question?
Is the same podcast that has been streaming on YouTube lately?
Is it this? Yes. Well, mostly what's been streaming on YouTube? What I've been streaming on YouTube?
Because I've seen sometimes that there are some videos that like I get notifications for.
Yeah.
And I look at them, but they're not like tax related, but
Yeah, so if you're subscribed to the channel that you're in right now with Money Study Group, that's a different channel and you'll get different subscriptions. So when you go to Missional Money, it's very similar content. It's just not specifically for students at the University of Houston. So if you subscribe to the Money Study Group, Millionaire Habits channel, you're getting notifications every time I post a video on that channel. You'll do the same thing on this channel. It's just a little different channel. Same idea though. When I do videos, I post them on YouTube just to let people know that they're there. But when you sign up for this, if you decide you want to do this, you'll be part of my online community and I'll be able to send you emails and keep you posted, and you'll be able to get coaching anytime you want. And I'll be doing some interviews as well in the podcast. So if anyone wants to, have a conversation about any specific topic related to financial planning or investment management, you will be like the first person that I'll say, yeah, let's have a conversation and make it part of the podcast if that's what you want to do. In the course, you've already experienced kind of part of like what the course will be like. It's the same platform. And I just upgraded this platform this semester. So the new Missional Money, it's like the next step for you. And I just wanted to make you guys aware of that. I've had some questions from students who wanted to know how they could continue to participate. And so this was my answer: to create something different and distinct, but it serves my clients, families of my clients, friends of my clients, and people that I know who just need to build a financial plan. It's free. There's no cost. It's going to be, I think, a very helpful resource for a lot of people. That's my hope, but it's for you. Not just you who are in this course today, but for all of the students who have taken this course over the last, I've been doing this since 2012. So if you know someone who's been in this course or thinking about this course, Missional Money is always going to be always available for students and for faculty at the University of Houston. Again, it's also available for my clients at Bayrock, family, and friends. So thank you for letting me do that commercial. Any questions, comments? Okay, next, I want to talk about insurance. So Let me go back to Wright Capital and log into Billy's plan, if I can. One of the things that, one of the questions we had to do with insurance. Some of you are finding that you can't add insurance in your plan, and I want to show you why. How many of you added homeowners insurance? If you haven't done it yet, it's part of this week's assignment, so you may not have done it yet. But some students have tried to do it and weren't able to do it, so I want to show you why. So let me go over that real quick. So I'm in Billy's plan. I'm going to profile. You notice those top tabs. I'm going to profile. And profile is one of the key top tabs in your financial planning portal. So remember, it's under profile that you have all these lower tabs: net worth, goals, income. Those are important, but I want to focus on these two links. First is the link account. Link account is if you want to add any account that you have. Whoa, that's weird. Yeah. So you can see in that, if you can see, well, you may not be able to see it, but it's taking us to Yodlee. That's the company that provides aggregation. So if you have a plan, if you're working on your plan, and you would like to see all of your accounts in your plan, this is how you link your accounts. So I'm with U.S. Bank. I've linked my accounts. If you're with Chase or Bank of America, you would just click on the institution and it will aggregate. It will link your account. You have to put in your credentials and it will link your account with all of the transactions, and that can be very helpful in your financial plan. So again, if you're thinking about moving to the next level after the semester, you might want to consider linking your accounts so that you have a much greater level of detail in your plan. And it's also helpful for your budgeting. I'm talking about real life budgeting. I'm not talking about your grade in this course. But back to the insurance. So you'll notice Billy has property and he has insurance, and you should have the same thing. I'm not sure you can see that because my face is in the way. But insurance, over at the left, you have property and insurance. So I'm going to open up Billy's property, and you see he has a home. I think what I'm going to do real quick is just go like this so you can see the whole page. So now you should be able to see the whole page. Sorry about that. So can you see that? Yeah, let me enlarge it. See, should be the same in your plan. You've got property. If you added your home to your plan, this is where it would be. Have you guys done that? Not the mortgage yet, but the property. So the mortgage and the property are different. You've got loan and property. See that? Uh-huh. So before you add the loan, you really need to add the property. So the way you do that is you just go up here and you add account, and you can see that when you add an account, you add the property, and then you'll go and add the insurance. So if you haven't done the assignment yet, this should be pretty helpful just so you know how to do it. You've already bought your home, right, in your plan. You purchased a home that you felt like you could afford based on the amount that you were going to be making when you get your job. So then this week's assignment was to add those assets to your plan and then add the insurance to your plan. So this is how you do that. It's really pretty easy. But what some people are finding is they've added the property, their home, they've added the property and they did just fine. They added the property with the amount and all of these pieces of data that go into the data card for the property, for your homeowner's policy, for your home. But what they didn't do, what they missed, is this little piece right here. So you see, when you put your property in, you can tell the computer, you can tell your plan that you rent or that you own. And so before you can add insurance to your plan, you have to tell your plan that you own. Okay? So I've had several questions. I can't add insurance to my plan. I don't know how to do that. Why is that not giving me the option? Question?
I think one of the problems that I had is that when we did the credit crush assignment and we looked for the mortgage and everything, I actually add the loan, like the mortgage on
Yep.
the loan.
Okay.
But
You didn't do the
I
property?
didn't do property.
Okay, yeah. So if you didn't do property, you'll want to do that. It just makes your plan more complete. Typically, if you have a mortgage, you own the property. And for a financial plan, one of the things we always want to know is assets and liabilities. So if you add the loan, but you don't add the property, then your plan is missing a piece. It doesn't have the asset. Okay, so just kind of inside baseball. It's not like I'm going to mark you down. But if you might lose a few points if your if your home insurance isn't added to your plan. I believe that's one of the screenshots I asked for. And so if I'm paying attention when I grade your assignment and that's missing, I might knock 5 points off. But if it's missing because you don't know how to add it, now you do. Because if you add the property and you make sure that you put own, not rent, then you should be good to go. You should be able to add the insurance. And then down here, we have insurance. So now I'm opening Billy's insurance, and it's basically just a few pieces of data. It's linked to his primary home, and it shows the premium, the annual premium, and the coverage amount. Okay. Now, where that premium comes from, though, is when we added the property. That's one of the pieces of data in the property is the annual insurance. See that? So when you add the property, remember this is financial planning. We're adding data to your financial plan. Every time we add a piece of data like a goal or an asset or a liability, there's lots of pieces of data that go inside that data card. And this one, the home that you own, comes with some costs. And so that's why this is an important data card for your financial plan, because if you own a home, there are some expenses attached to it. There's taxes, there's insurance. Plus, we want to know how much did the home cost? What's its current value? How much is it going up? How much are the taxes going up? All of that stuff is built into your financial plan. So think about 20, 30 years from now, you're going to want to see that information kind of demonstrated in your financial plan. As a financial planner, I need that information so I can give you good advice. Like, should you refinance your loan? Should you pay it off? There's lots of things we can do if we have the information. So I'm asking you to put some information in. Again, I'm not going to mark you down for getting any of this wrong, but I do want you to think about, in the process of researching your home, I want you to think about these particular pieces of information and do your best to come up with something that's reasonable. Like if you bought a house in Bel Air for $500,000, I would appreciate if you thought about how much are the taxes. It shows me that you're thinking about the real implications of buying a house, which is my goal in teaching you about personal finance, is to help you understand as many pieces as possible. So when we buy a house, we need to know how much is the insurance, how much is the taxes. Is the taxes going up? In my house in Friendswood, the taxes have gone up a lot. So I'm not going to make you an expert on buying a house, but I do want you to be thinking about the pieces that go into that puzzle. And the data cards are a really helpful little tool because they can give you an indicator of what do you need to research, right? And it shouldn't be that hard for you to figure out what are the taxes in the zip code where you bought the house. Am I right? If you want to know that information, you should be able to get that. Again, I'm probably not going to go deep into your assignment and see if you did the work, but I do want you to know why this assignment is what it is and what I'm hoping to see in terms of your comments when you post it. But again, I hope you guys realize I'm pretty generous when I grade your assignments for the most part. And if you do them early, you're going to get extra points. And if you do them last week early, like way ahead, you'll get even maybe more points.
This week's assignment, for example, the one that we signed last week.
So I had an assignment that was due in Blackboard today, the insurance assignment. Week, yes. Is it week? It is week 8. Yeah. Week 8 insurance. I had it due today, but the syllabus says it's not due until next week. So just to be fair, so nobody gets penalized, I changed the date yesterday so that it's not due until next week. So I'm saying if you turn that assignment in that's due next week, if you turn it in by Friday at 3, I will give you extra points. However, if you saw the assignment due date was today and you turned it in last Friday early on spring break, I'm going to give you extra points if I think about it because you were way ahead of the game. That's what I was trying to say. Sorry if that's confusing, but nobody's going to be penalized. It's due next week. So, any questions about that? Any questions about that assignment? Let me see if I have any chat. No chat. Okay, any questions? Before we move into, I want to just talk a little bit about insurance.
For the auto insurance, it's the same thing.
For what?
The auto insurance.
Yeah. Let's look at auto insurance, in fact. So if I look at Billy's super cool car insurance, we'll see this is the data card for the car insurance. Remember, hopefully you added the vehicle as an asset, which you would do right there. I think you would call it, what would you call that? Huh. No, it's not property. Is it other? I guess that's how we did it. Does anybody remember how you added your car? I'm assuming you guys did add your car as property. I mean, I added it for Billy, so. Oh, I didn't add it for Billy. Is it under other? No, I don't even have it for Billy, so. We have loans. So for the autos, we didn't add that as property as an asset, but we did add it as a loan. And so for autos, we want to add insurance. I mean, you can. It's part of the assignment. So if you want to see what it looks like to add insurance. And by the way, if you have a loan, whether it's for your car, or your home, you have to have insurance. And that's why we made it part of the assignment for you to add your insurance to your plan, because if you have a loan, you have to have insurance. So I added insurance for Billy's super cool car, and I want to spend a couple of minutes reviewing what's in this data card because it's a helpful way to review car insurance in general. Part of your assignment is to get a quote for your car insurance this week. So what I would encourage you to do if you missed it last week or the week before is if you already have car insurance, if you're on your parents' policy or you're already on any policy, I would go to the company that already insures you, and I would get a quote, a comparison quote, and just learn the coverages and get some quotes for something different. So I'm going to talk about what could be different here in a minute, but that's the easiest way for you to complete that assignment is you don't need to go shopping at a new insurance company. If you've already got it, just get a quote from your current insurance carrier. That way you're not getting bombarded with quotes from all these companies. Because if you go to get a car insurance quote online and you give them your information, you're going to get insurance quotes forever from 100 different insurance companies and agents. So I wouldn't do that. Yes, sir.
So is the insurance quote based on our car that we chose, right? Not our
Correct. Yeah. I would do that. Like if you're on your parents' insurance, then I would go to them and I'd say, hey, I'm thinking about buying this Tesla and I'd like to get a quote. That'd be the best way to do it. And they're not going to add it to your policy because you don't have to tell them it's a fake car. Just tell them you're thinking about getting whatever you put in your. Yeah, yeah. Just tell them you could tell them you're doing an assignment, and they might get mad at you, and you might have to buy them a Coke. But just depends on where you're insured. I'm insured with Progressive, and if I want to do a quote on any vehicle, I can do it online with my company without having to go out and. So I'm just saying, be careful that I don't want you to go out and do. I'm looking for insurance. Give me a quote because you'll get bombarded. Yeah, so just be careful how you do it, but that's what I would do. Okay, good questions. Let's talk about insurance. This is a car insurance data card. You guys see these coverages? That's what you're going to do when you get your quote is you're going to be getting a quote or a comparison for different coverages. When you look at your car insurance declaration page or your quote, you're going to see liability. The first line is going to have two numbers on it. And it's going to be these bodily injury, those two numbers. And it's usually going to be like 50/100 or 25/50, or in Billy's case, 100/300. It's called liability, bodily injury. Do you guys know what those numbers mean?
How much it'll pay?
Yes. How much the policy will pay, but specifically what? 100/300 bodily injury, that's how much the policy will pay, but tell me how that works.
I mean, if you're over 100, then that's on you. That's stuff.
Yeah. Yeah. So 100, but what's 100 for?
Like medical expenses.
So it's, do you see that? Can you see that? So the $100,000 is per person. Yep.
Isn't that kind of a good policy though? My policy covers like 25,000.
It's a really good policy. This is what I sold when I was a State Farm agent for many years in Clear Lake, Texas. This was every agent, every insurance company, every agent, they have some template, some default set of coverages. So when you walk in their office and say, I want to get a quote for insurance, they typically print out the same package for everybody. Doesn't mean that's the package you need. It's just the package they put together based on their market and their preferences. And so this was the package that I used for everyone because of because of what I know about the cost of medical and accidents. And remember, what you're doing with your liability is you're protecting your assets, right? If you have an accident that's your fault and you get sued, your insurance company is going to pay up to the amount that you have coverage for. If you have very low coverages and you got cheap insurance, way to go. But if you've got a lot of assets and somebody sues you, you're going to reach in your own pocket and pay that claim. So that's why this is important. So I want you to know what these coverages are. So the first one is per person. That's what that first number is, per person. The second one is per accident. So per person and per accident means that your policy is going to pay. If you get in an accident, let me give you the same example I gave the earlier class. Billy gets in an accident and it's his fault. He's driving his big monster truck, which is a very cool truck, but he's not paying attention. He's drinking his monster drink, which is maybe something else involved as well. I'm not really sure, but he gets in an accident. It's his fault. His accident happens to be with a school bus. There are 20 kids on the bus plus the driver. And everybody goes to the hospital. Out of the 20 kids, 20 of them have $50,000 in medical bills, and the other 20 die. So, how much will Billy's policy pay for each of the kids on the bus?
Wait, half of them died.
Yeah, 10 of them died when the bus rolled over and went down a cliff.
200,000, and that's it.
How much?
200,000?
Three. So yeah, 300,000 is all this policy is going to pay in total for this claim. So how much will each individual get?
Divided.
They're going to have to figure out something. I have no idea. They're not going to get much. So each of the kids that died, their parents who sue the insurance company, they're going to get policy limits are going to get paid out quickly, and then Billy's going to be on the hook for the rest. Okay, so that's a silly example maybe, but that's how it works. And I just want you to know how it works. For those two coverages, bodily injury, the two numbers, the individual and the aggregate or the per claim. Okay, and if your policy says 2550, now you know what that means, right? So clear? Now let's look at this other number. It's called property damage. This is still under liability. So Billy, again, same scenario. Billy gets in an accident with a school bus. This happens to be a school bus that is really, it makes Kamala Harris, our vice president, very excited because it's an electric school bus. Instead of costing $100,000 like most school buses, this electric bus cost $1 million because it's electric, it's a new design, Tesla made it, it's a protege, it's really cool, but it's pretty expensive. And Billy, in the accident that he caused, it's his fault, the bus gets destroyed, it's totaled, it has to be replaced. He has $50,000 property damage. How much is his insurance policy going to pay for the school bus? $50,000. So yeah, that's how that works. Yeah, so umbrella coverage is really important to think about at this point. It's umbrella coverage really isn't very expensive, and it typically starts at $1 million. You can do 2 million, 5 million, 10 million, but typically a PLUP, a personal liability umbrella policy, starts at $1 million. It's pretty inexpensive, like usually a couple $100. So if you have assets, it's a good idea. I recommended it always. Yeah, it's for people. All of liability insurance is to protect your assets. That's all it is. No, the bare minimum liability protection is the bare minimum that the state requires. But liability, the general idea is, yeah, it protects your assets. And the state tells you how much the minimum is so that you have to have that much. But liability, it's not, if you think about liability just as the minimum, that's what the state says. But as you can see, if you're someone with assets and you have the minimum because you wanted cheap insurance, you're probably pretty stupid. Yeah, they're going to go out. And what assets would you have if you're Billy in this scenario, the school bus? What assets does Billy have, even though he's buried in debt? He has a lot of stuff, but he has a lot of debt. What does Billy have in terms of an asset that they could go after? His house, his car, but the bank owns those. His liquid money, but he's got none of that because he's buried in debt. He's got something really valuable, just like you. He's got his earning capacity for the rest of his life. So what happens in a scenario just like this is Billy's wages will be garnished. So they will file suit, they'll win the suit, and the judge will say, hey, for the next 20 years, you need to pay them $400 a month, every month. And they garnish his wages so that everywhere he goes, the employer pays them directly. He doesn't, it's not like child support where he gets to decide, I'm going to make it or not. No, they actually attach it, okay? So you need to understand liability. You need to understand how it works. It's the reason you're getting a car insurance quote. Take a look at your coverages. If you've got the minimum, take a minute, just think about what would it cost to increase it to something that gives you better protection. Now, if you have no assets, remember, you have your future earning capacity, and that is an asset. Just remember that.
Quick question. So, would it be easier, like Daniel said, to just file for bankruptcy?
Yeah, filing for bankruptcy might work, but they might still garnish your wages. But bankruptcy is, yeah, I'm not.
Suicide at that point.
Daniel said suicide at that point. That's not a good option, never a good option. Bankruptcy may, it depends on how they, I don't know, honestly. Bankruptcy, I'm not a specialist in bankruptcy, but yeah, so just remember that your future, liability insurance may seem expensive. Get a quote, find out if it's really expensive. Maybe instead of the minimum, you have a little more. Okay, that's liability on your car insurance. Any questions about that? Yes.
The umbrella policy is only for cars, or can you just to any?
Umbrella policy, they call it an umbrella policy because it goes over and above your property, your cars, and your home. So let's say you have $1 million PLUP. That coverage covers you over and above. So in this scenario with Billy, most insurance companies, when I was a State Farm agent, it certainly was true there. You couldn't get an umbrella policy unless you first upgraded your coverages in your car insurance policy. So instead of 100, 300, you would have to upgrade that to 250 and 500. So if you had assets and you were wealthy and you needed to protect your assets, that was kind of a no-brainer. You had to do that with State Farm to upgrade your auto policy so that we could sell you an umbrella policy. Yes.
The umbrella policy also covers like legal stuff.
Yeah. The question is the umbrella policy, the personal liability umbrella policy, or PLUP, covers legal cost. And that's a really, really good question, a really important question. So let's go back to the scenario where Billy gets in an accident with a school bus, 20 kids, and a bus driver. And the bus is destroyed. Let's make it a reasonable scenario, though, like where the kids, half of them don't die, but maybe one of them dies because but the way that he died was a little unusual because this kid was playing with a sharp pencil, and when the accident happened, he contributed. It's a long story, but always claims are complicated. And let's say that it wasn't Billy's fault completely. It's kind of unclear. Maybe the bus driver was the one who was drinking the monster drink that had the, something extra in it. So it was a different scenario, but it was still a bad accident. But in this scenario, Billy's got an umbrella policy. And so he gets in an accident. It looks like it might be his fault, but it's not absolutely clear. Those are the kind that the insurance company is going to do what? The question initially was, what about the cost of expenses for the lawsuit, right? Legal expenses is what you said. That means lawsuit expenses. You go to court, you need an attorney. Those expenses can be very high. And so in this scenario, Billy gets sued. Obviously, somebody's going to sue him out of 20 people, and the bus driver and the school district. He gets sued, but he has an umbrella policy. The beautiful thing about an umbrella policy is it does pay, just like your homeowners or your auto insurance, they all pay under liability. They pay the legal expenses. The difference is if you've got minimum coverages and you get in an accident that's your fault, what is your insurance company going to do immediately? They're going to write a check and pay the limits and then let you be on the hook for the rest. Think about that. Let that sink in. You carry the minimum liability insurance. You get in an accident, it's your fault. Somebody gets severely hurt or dead. You have minimum coverages. Your insurance company is going to pay to defend you in court, but only until they determine that they owe policy limits, at which point, if they're smart, they're going to write a check and pay it out so that their liability ends. They're not now obligated to cover your legal expenses because they've paid the policy limit. Okay? Does that make sense?
Yeah, for example, they'll pay, I don't know, for the property damage right away and get rid of the.
Yeah, or let's say that Billy has 25, 50, 25. Same scenario. The insurance company is going to pay $25,000 to the first two people that provide their claim. 50,000 total, they're done. They pay for the bus. Here's the check. That's going to cover it. That's all we got. And they're going to close their claim. They are done. They've paid policy limits. Now, Billy, when Billy gets sued, he has to go to court, has to hire his own attorney, has to figure out how he's going to pay out of pocket for the rest of the damages that were not covered because his insurance policy was too low.
I have another question. So let's imagine that it's not like a super sad scenario in this case, and just
A normal scenario where it's just a broken arm. Nobody died.
Just like a bump,
Okay, good. Let's go with that.
just like a small crash or something. Like
Small crash.
And okay, your insurance covers it and still gets rid of all the liability. For some reason, they find a way to spend it all. After that, the insurance company will still be your insurance company, or you have to look for a new.
So that's a good question. So the question is, you get in this claim. It's not the tragic school bus claim where people died. This is a more minor claim. The insurance company pays the claim. The question is, after that, are you still insured with that insurance company? And the answer is typically almost always yes. Now, if this is your fifth claim or your third claim in 3 months, that's a different story. But they're typically not going to cancel you for one, even if it is a bad claim, unless it was some situation where you, like if you were drinking and you got cited, a ticket for being under the influence, that's a different story, and that depends on the insurance company's underwriting guidelines. Some of them are very strict, and they just cancel you for that. So that's a good question, but let's go back to the umbrella policy. I want to make sure, because you asked a really good question about legal expenses, and I want to make sure that everybody understands this, because it's important, I think, to understand when you're talking about an umbrella policy. So in this case, Billy, let's pretend that he gets in a bad claim. It's his fault. He gets sued, but he does have that $1 million umbrella policy. But the damages aren't like severe. Like I said before, people died. Nobody dies, but there's some pretty bad, injuries. His insurance company, he gets sued. They sue him because they find out he's got all this coverage. So they want the $1 million plus the underlying. That's $1.3 million. That's what the insurance company's limit is now. With the umbrella and the $300,000 aggregate, it's $1.3 million. But the damages don't come anywhere near $1.3 million. So if you're the insurance company and you have to cover the legal expenses, what are you going to do in that scenario? Are you going to pay policy limits so that you don't have to pay the legal expenses and then let Billy be on his own? Or are you going to pay what you think is fair and then fight in court to prevent paying more and cover the cost of the legal expenses? That's how you want to think about it. What would you do if you were the insurance company? I'll tell you the answer, but I want you to think about it for a minute. What would you do if you were the insurance company? And the simple facts were you've got $1.3 million of coverage and probably somewhere around $150,000 of medical bills and pain and suffering and some little property damage. What are you going to do if you're the insurance company?
And what's the limit?
$1.3 million. Say that again? Yeah, of course. Everybody wants once they know what the maximum is, they want it all. Their attorney wants it all. What was that? Yes. The policy limits get disclosed once you file suit in discovery. You find out real quick.
Would you try to negate that and try to see it's a little bit less than 1.3?
So Daniel says, wouldn't you try to mitigate that and negotiate and say it's a little bit less than 1.3. It's a lot less than 1.3.
Go into like investigation or whatever.
Oh yeah, absolutely. The insurance company's supposed to do a thorough investigation. And they discovered in their investigation that, it wasn't completely Billy's fault for one thing. He's at fault. Clearly if they go to trial, a jury could say it was all Billy. But most likely they're gonna say it wasn't all Billy. And in the state of Texas and different states, that makes a big difference too. But at the end of the day, let's just say that the damages are way less than 1.3. And Billy has this umbrella policy over and above his underlying 300,000. So he's got coverage for 1.3 million. What do you do if you're the insurance company? Do you pay it or do you defend it and incur the legal expenses for as long as it takes to defend it? What'd you say?
Probably just pay it because I don't know how long it's going to take.
Yeah.
How many expenses are.
So pay it because the expenses could go on and on. Daniel?
Obviously, like project how much if it's over 1.3, it might as well just pay the 0.3, right?
Yeah, that's what happens is the insurance company has to do some math and figure out, okay, we think our exposure here, if we go to court and we lose, we think we might end up with a judgment against us of 500,000 plus expenses. So what is that total? And they make a decision. But they typically, with $1.3 million coverage, they're going to defend it. They're going to hire the best lawyers and they're going to do as much as they can to negotiate a settlement, and they're not going to pay it because they have way too much coverage for a claim that really is nowhere near 1.3 million. So the point is, though, the legal expenses get covered. So if you're Billy, you don't have to worry about it because the insurance company's paying all the cost to defend that as long as they want to defend it. But if you only have minimum coverage and clearly the damages exceed that, they're paying the claim and you're still getting sued, but now you're paying the bill. That's what I wanted you to understand. There's a huge benefit in having an umbrella policy, and there's a big benefit in having more liability coverage because you're going to get your insurance company is not going to give away money, but they're going to defend you. If you have higher limits, they're going to defend you a lot more aggressively than if you have the minimum. And if you have the minimum and you get sued, you're on your own. Okay, does that make sense? That's why I want you guys to understand these coverages so you can be a well-informed consumer. So when you go shopping for insurance, you at least know what you're looking at. Okay, that's what that's about. Any other questions about liability or property damage? And again, the property damage is just for property. It's not bodily injury. It's the school bus, it's the light post that may have gotten broken, or the telephone pole, or the building that got ran into. It's property. But it's all the property related to the accident that was Billy's fault. Yes?
Generally, when the person suing the insurance company, they are trying to get that 1.3 million, and it was really only like 150,000. Do they get only that 150,000, whatever the appraisal is from like the jury or whatever, or do they get 500,000 in like a settlement or something?
That's a great question. So, insurance companies, depending on the location, like I worked in Galveston County juries really like to beat up on insurance companies. So, you didn't want, if you're the insurance company, you knew that. You didn't really want to go fight it in Galveston if it was questionable. So, you would negotiate and you might pay more than you normally would pay because you were in Galveston. But if you're in Boise, Idaho, or wherever, it could be different. So it's a good question, but the answer is a little bit based on a lot of what ifs. The bottom line is the insurance company is going to defend it if they think they can get away with not paying, the limits. And if the limits are high, they're more likely to defend it than if the limits are low, because it's a dollar thing. Does that make sense?
I like how it all ties up to capitalism.
Yeah, exactly. Okay, so let's talk about comp and collision real quick. If you have a loan on your vehicle, do you have to have insurance?
Yes.
Yes. And you have to have comprehensive and collision. They don't typically require, I don't think they typically require that you have a certain level of liability insurance. But if you have assets, the more assets you have, the more you want to have higher liability for property and for liability. So just know that. And your ability to earn income for the rest of your life is an asset. Remember that. Comprehensive, what does the word mean?
Everything.
Everything. So what's covered under comprehensive? Everything except what? And any coverage, no matter we're talking about life insurance, health insurance, property insurance, home, car, business, every coverage has a list of things that are not covered, and those things that are listed that are not covered are called exclusions. So comprehensive, while it means everything, comprehensive, and it does cover everything, it's comprehensive, except the things that are listed as exclusions. What's the number one exclusion for comprehensive? Thank you. Collision, yes. That makes sense, right? You're not going to give away collision, which is the most likely, statistically most likely thing that's going to happen to the vehicle. So you're going to pay for that coverage separately, and that coverage covers only collision. Doesn't cover anything else.
So, for example, comprehensive also works if you have a flat tire.
It's a good question. So comprehensive works if you have a flat tire. So I have a flat tire. I had a flat tire. I have a flat tire right now. It's not flat, but it's leaking. It's going to be flat. So could I file a claim under my comprehensive because I have a leaking tire? No. What was that? It depends on the deductible. That's a good point. Let's talk about deductible. But first, let's talk about the number one requirement for any insurance, property insurance, to be covered. So even though you have comprehensive that covers everything, unless it's excluded, there's a thing called an insuring agreement. And that's like a paragraph, a short paragraph that says, we cover everything as long as it's sudden and accidental. So my tire's leaking over time. That doesn't qualify for sudden and accidental. But what might be sudden and accidental that gives you a flat tire? Running over a nail. Would that be colliding with a nail? No? Okay. I had a flat tire in my Lexus. It's a 2007 Lexus ES350, beautiful car. I gave it to my daughter, but I was driving it and I was checking my messages. I admit, it was the only time I ever did it. It was raining and there was a new median in the road. I've been on this road 1,000 times, but they put this new median, which means a curb, and I'm cruising down the road and it's raining and I'm not paying close attention. I'm looking at my phone and I hit a curb. Left side of my blew out my tire. So would that be covered under comprehensive? Why? That's collision, but I got a flat tire. So see, when you say is a flat tire covered, you have to say what caused the flat tire. In this case, it would not be covered under comprehensive because it was collision. And the only way a flat tire that I know of would be covered under comprehensive would be if it was vandalism. Sudden and accidental, vandalism is covered under comprehensive. If somebody sticks a knife into my tire and makes it flat, that would be covered. Questions? A pothole would be a collision. If you run into a pothole in the road and it makes your tire go flat, that's a collision. You collided with a pothole. That,
I was gonna say that.
well, you don't. The insurance, because of the nature of comprehensive coverage, ironically, it's a good question. How do you prove that it's vandalism? Ironically, the insurance company would have to prove that it's not, because you're filing a claim for vandalism because you have a knife poke in your car, in your tire. I'm assuming you can see a knife poke. You're thinking they poked it in the tread and it might have been a nail. But I'm saying if it's vandalism, they stuck it in the weakest part of the tire, which is the sidewall, and it's pretty easy to determine. But the bottom line is the insurance company would have to determine that it's not vandalism.
So what's stopping you from, like, you see that you just hit a curb and your tire's blown out, or it's about to be, and you just stab it?
So, what would prevent you from creating a claim and committing fraud?
I think personal ethics.
Personal ethics and the law, because you could go to jail for that's a fraud. That's a felony. If you got convicted, chances are you probably wouldn't, but you get canceled. I mean, do you think? Well, I'm not going to get into. Yeah, I better. We're on Mr. Internet. I better chill. So comprehensive, very broad, covers everything unless it's excluded. Collision covers just collision. Both of those coverages have a deductible. So let's talk about deductible for a minute.
Yeah, I have a question about collision coverage. So when they give you that comprehensive insurance, and then there's a bunch of exclusions, do each of those exclusions have their own coverage like collision?
No, that's a good question. So comprehensive, everything's covered unless it's listed as an exclusion. The question was, do each of those exclusions have their own alternative coverage like collision? And the answer is no. Collision is unique in that way because collision is like a predominant peril, one that's very common, so they provide a coverage for collision. But they don't provide coverage for inherent vice, for wear and tear, for rust, rot, mold. Those things are they all happen over time. They're not sudden and accidental. They're specifically excluded just to make it clear, so they're not covered. Now, one thing you should know that is covered under comprehensive is flood, hail, wind, hurricane. If your homeowner's policy has exclusions too, and your home excludes flood because that's a main peril for your home. But for your car, that's covered under comprehensive, comprehensive is my favorite coverage on any policy. It has the most benefit. There's so many ways you can use collision coverage. And I usually tell stories about that, but I'm losing my voice today, so I'm not going to. And we're online. Yeah, you got to be careful what you share online. It's not like Vegas. No, actually, comprehensive is generally a little bit less than collision, but it depends on the car, and it depends on the age of the car. But typically, all things being equal, comp is usually, and it also depends on the deductible because I don't know about most, I really don't know if this is a true statement, but when I was a State Farm agent, you could select your deductible for each coverage separately, right? So you could have a $0 deductible for comprehensive and $1,000 deductible for collision. That was like the best possible deal. No deductible comprehensive. And it wasn't that much more expensive, but you have to do a quote to figure out if what I'm telling you is true because your company may be different, your car, your area. But when I was in Pennsylvania, when I started as a State Farm agent, we offered what we called full comp, no deductible. And since comp covers so many things, you could have a lot of claims on your policy with no deductible, and you didn't get canceled because they don't really cancel you for comp claims. They can't cancel you for collision claims. I see two questions. Yes.
For all those previous scenarios that we've been dealing with, like a broken arm or the kids died, is that collision or is that comp?
It's neither collision or comp. The scenarios where people had bodily injury, we were specifically talking about liability coverage. So liability coverage is one thing. Property damage under liability is only for the other person's car. When we talk about comp and collision, we're talking about your car under your policy. And if you don't have those coverages, you will not get paid when your car gets damaged unless you happen to get in an accident with Billy and it's his fault, in which case his property damage will pay for your car.
And you don't need to have these coverages, right? You have to have coverage for the other people.
You have to, if you're going to drive, you have to have liability protection. If you have a loan on your vehicle, you have to have comp and collision. Does that make sense? You had a question?
I forgot. Now the other question is about the maintenance of the car. That's basically on us. Everything.
Correct.
There's no insurance.
No insurance for maintenance. Now, you can get a car warranty when you buy a car from a dealer sometimes, but it's like insurance, but it's really not usually a good deal. So, okay. Deductible. You guys know how the deductible works?
I'm so sorry.
Oh, that's okay.
It's the thing, like the amount of money that you pay before the insurance starts paying.
Remember, insurance is a way to transfer risk to the insurance company, and your deductible is the amount that you decide to keep for yourself. So if you have a high deductible, you're basically saying, in this case, Billy has $1,000 deductible. So if he gets in an accident and he files a claim for his vehicle, he's going to have to pay the first $1,000. So for example, his truck, he's got a really cool truck. It's probably worth about 50 grand when it was new. He gets in an accident, there's $10,000 worth of damage. He has a collision, runs into a tree because he's drinking that monster drink with the X. Anyways, magic mustard, you say? Oh, Magic Monster. Yes, that's good. Magic Monster. So anyway, so Billy has $10,000 in his claim. That's what it's going to cost to fix his truck. He's got $1,000 deductible. How much does he have to reach into his pocket for? $1,000. So now my question is, if Billy had a $500 deductible instead of a $1,000 deductible, how much would he have to reach in his pocket for? $500. So now my question is, would Billy's policy premium, the cost of his insurance, go up or down if he changed his deductible from $1,000 to $500? It would go up. So how does Billy know which one of those is the best option for him, to have a $1,000 deductible or a $500 deductible?
Well, since he's getting into crashes pretty often, he probably need the 1,000. I mean the $500.
Well, so Daniel had a great point. He said since he gets into a lot of crashes, he's better off with the $500 lower deductible and paying the higher premium. But what Daniel doesn't know is after that first claim, Billy gets a surcharge on his policy and the premium goes up 15%. And after the second accident, his policy goes up 25% more. And so every time it goes up, the cost of his insurance relative to his deductible changes. And the only way to really know is to get a quote.
The deductible goes up as well.
No, the deductible doesn't automatically go up, but the cost of the insurance goes up, which means that if he has that low deductible, his savings from raising his deductible is probably going to increase as well. So your point, Daniel, that he's better off with a lower deductible may not be true. He may be better off with a higher deductible, even though he's getting in more accidents, because the cost of his insurance is going to get exponential. And so the way that you want to decide what your deductible should be, when you do your quote, if you go to your insurance agent and you say, hey, I've got a $250 deductible, and I want to see what I would save if I get a $1,000 deductible. If you're saving $750 a year by raising your deductible to $1,000, how long will it take for you to break even so that if you do have an accident, you got to reach in your pocket and pull out $1,000? How long do you have to go without an accident before that makes sense for you to? How much? Yeah, 15 months exactly. 1 year and 3 months, 15 months. Does that make sense? That's how you figure it out. And if you think you can drive carefully and you're not like Billy having a lot of accidents, then you're going to want to do that $1,000. If in that scenario it saves you $750 a year. Now that's an exaggeration. It's probably not going to save you quite that much, but you see how you would figure it out. Maybe it takes you 24 months of not having an accident. You can do the math. But that's why I want you to get good at getting a quote for your insurance, because once you start paying these bills on your own, insurance is a big part of your budget. And the way that you try to manage that part of your budget is by being well informed about the coverages that you have on your policies. Does that make sense? Good. Can we move on, or do you want to talk? Yeah. Oh, you guys, any other questions about insurance?
My biggest question right now is what kind of insurance does Batman has?
Does who have?
Batman.
Batman.
For Batman.
Yeah, he has
There's no way.
Lloyd's of London, I'm sure. Okay, let's see. What's next? I think I'm going to wrap up and talk about the perfect investment, segue into investment management, and let you guys go. How's that sound? So, when I say the perfect investment, what do you guys think of?
Diversification. Oh, like an asset.
I mean, I don't know. I just want to know what you think of.
Not a car.
Not a car? Yeah, not a car. Not a car. Not even the Batmobile. So I'm just while I'm talking about this, I'm opening up if you think about your plan, those upper tabs you see in kind of in the middle is retirement, and then we have analysis in the lower tab, right? The reason I'm mentioning this is because next week I'm going to give you an assignment where you're going to have to calculate the cost of retirement. Okay, so as we get into investment management, investment strategies, I want to set the table by giving you an assignment where you can go and actually see how much it's going to cost for you to retire at whatever age you decide to retire. And so this piece of your financial plan, this is like the most important page, the most important collection of data. All of these data cards come into this one place. And this is where you can make a lot of tweaks in your financial plan that will move the needle on your retirement. So this is a really important place for you to just get familiar. So you saw how I got there. And I'm just going to leave that there because as we move into investing, your assignment is going to be to calculate how much is it going to cost for you to retire. So remember the baby steps, Dave Ramsey's 7 baby steps? One of those baby steps says you should save this percentage towards retirement. I think it's the 6th baby step. Maybe it's the 7th, but it's one of them. It says you should save 15% for retirement. So as you get ready to do this assignment to calculate the cost of your retirement, what I want you guys to experience, what I'm hoping is that you experience how hard, how heavy, how difficult it is to save for retirement. Like the amount of money you're going to have to save and invest over time to be in a position where you can choose to quit working when you're 50. Because remember, the big idea, the big goal of this course is to become a millionaire by the time you're 50, so that you can decide at that point whether or not you like working for a company or you want to do something else with your life. So calculating the cost of your retirement is going to be a big part of this course, as well as your capstone, and that assignment is coming next week after we finish insurance. Take care. See you later, Ashley. So as we set this up, I want to remind you one of those baby steps was to save 15% of your income towards retirement. Does that seem like a lot to you?
I was with the us do like the 401ks and the IRA, IRAs and all that.
Yeah. So we're going to talk about those types of accounts. But to set that up, I want to talk about the perfect investment. So right now, let's just assume everybody's making 100 grand. We're all making $100,000 a year in our job. To save 15%, how much do we need to save? 15,000. So that's simple math. Now, I want to teach you about the perfect investment. What do you think of when I say the perfect investment?
I think it would end with diversification, like having
Diversification. So that's a strategy. That's an investment strategy. Anyone else? It's not the right answer, but it's a good answer. A Roth IRA, that's a type of account. It's not an investment, it's a type of account, but it could be close because the perfect investment is also involves a type of account, but it's not the Roth IRA. But that's a good answer.
savings.
It does involve saving. So here's what it is. It's when you get to work, you graduate from college, most of you are going to go to work for a corporation. And most of those corporations are going to have a 401k savings plan. It's going to be part of your benefits package. And most of those 401k plans are going to have what's called a company match. And that is the perfect investment. And here's how it works. So we all make 100,000. Let's say you go to work at Shell. And Shell Oil has a match of 8%. I don't know if that's true, but let's just pretend that's true. So the day that you start working for Shell after you graduate, you're going to go into HR and they're going to ask you a bunch of questions. And one of the questions is, do you want to participate in the 401k plan? And your answer is going to be absolutely yes. The next question is, how much do you want to contribute to your 401k? And that answer is going to require you to know how much is the match. How much is the match? It's 8%. So you're going to say you want to at least contribute how much? 8%. And here's why. You're making $100,000. You sign up for the 401k. They have an 8% match. You sign up for the full 8%. How much do you put into your retirement account in that first year? 8,000. At the end of the year, after you put in your 8,000, how much do you have in your retirement account? 16,000.
So that, like, because let's say if I'm working right now and then I move to another job, so that I have to transfer my 401k, right?
So if you go to another job, you don't have to transfer your 401k. You can't transfer it to the next job. You could roll it over to an IRA, but was that your question?
Well, I guess you answered that, but my question is like, in the future, when I'm ready to take that money out, does it like accumulate taxes or does it like adjust for inflation?
That's a great question. How does that account work later on after you leave your employer and so on? And that we're going to cover not next week, but the weeks ahead. But for now, I just want you to know how you grow that account using the company match. And so those are good questions about what happens if you leave. So for example, most companies, if you leave within 3 years, you don't get to take your match with you. And if you don't know that and you're contributing that 8% so that you get that match, if you're smart, you're going to work there 3 years. I mean, there's going to have to be a really good offer on the table for you to leave and give up that 3 years of match. But if you don't know that, well, you're going to miss out. But you need to know that. So the 8% match not only gives you that 100% gain, why it's the reason it's the perfect investment, in my opinion. By the way, full disclosure, since I am a fiduciary and I am an investment advisor, I have to say there is no such thing as a perfect investment. But if there was, it would be this. It would be the company match. You can't imagine how many people I've worked with over the years who have not taken advantage of the company match. It just boggles my mind to think that you have that opportunity and you don't take advantage of it. It is the perfect investment. So not only do you get the match so that at the end of the year you have 16 grand in your account, what else do you get? You get a tax deduction. So instead of the IRS saying you made 100 grand, they're going to say you made 92,000. See you next week. So does that make sense? So that's why it's the perfect investment. I think we're out of time. We are out of time. Thank you guys. We'll see you next week. We will talk about 4 investment strategies designed to maximize returns and minimize risk. As you guys are walking out, for the people on Zoom, or maybe on Facebook or the YouTube, I'm going to tell you what those strategies are, and then I'm going to shut this thing down. Never enough time. It's not what my voice is saying right now. Number 1, diversification. I'm going to tell you the story about the Enron investors. That's the first investment strategy designed to help you maximize returns and mainly minimize risk. Number 2 is asset allocation. The single most important determinant of your portfolio's returns is asset allocation. You're going to want to know how that one works. Number 3 is the most powerful investment strategy. Have a good week. The most powerful investment strategy for folks your age in your age group. For the longer you're investing, the more powerful this strategy is, and it's called dollar cost averaging. I'm going to tell you a story about Farmer Joe, and you'll understand how that strategy works and why it's so powerful. And the 4th investment strategy designed to help you maximize returns and minimize risk is portfolio rebalancing. So those are the 4 strategies. We'll see you next week, and we'll go over them. You're welcome to come in. I'm just shutting things down. Y'all have a great week. I got to go. Okay, we're going to end.